That's how it works. And you're bidding on that opportunity to make you that loan. I'm not talking about the captives like Ford Motor Credit or GMAC or something like that. But that's how it works. It's all based on computer modeling. So that person at the branch, he or she might make you feel like they just gave you that loan, and maybe they did because they gave you the check. They didn't do that, and it would be very cost ineffective to do it any other way. So our underwriting probably is based on, you know, how ordinary or how different anything is. That would not be the way we would look at a company with $100 million in sales, obviously. And quite frankly, it's easier to look at a public company than it is a private one, because you got public information. Has to be a student that has the question. By the way, why is everybody at Michigan State so fun? I know everybody likes a winner, but I know there's this Oakland U kind of thing. But good Oakland shirt. We're just talking about that at a board retreat. We have to get more Oakland University apparel. Yes, sir. Speaking of Michigan State.
I'm an undergraduate, that's why I'm doing this here. Does Tennessee work directly with Dan Gilbert and, I guess, Quicken Loans as a unified effort to revitalize Detroit, or is it more individual?
Probably more individual. Let me give you an idea. We're in probably 6 or 7 funds, FUNDS, that is sponsored by MEDC, which is Michigan Economic Development Corp. I have to prove that those are exempt from the current regulatory. Banks cannot lend or cannot invest in funds anymore unless they get what's called a Volcker Rule exemption, named after Bernanke's predecessor, that says that it's for economic development. So we're in the Grow Michigan Fund, we're the largest investor. We're in the Grow Detroit Fund, we're in the Woodward Corridor Fund. So that's one area we help. We also have second chance mortgages as well as second chance checking accounts. Second chance meaning part of our financial literacy efforts. You know, people that have been kicked out of a bank, if you will, for too many overdrafts or whatever. So let me give you an example of something that we do. We've been pretty successful on. This is a smaller project, but I think it underscores our view. There's something called Hamtramck Recycling Plant, and we not only made an investment in there of new markets tax credits, but we also put together some financial literacy around that, because what people found out is, you know, they said, hey, congratulations, we gave you a job. We worked with a company, not-for-profit called Access. You get chronically unemployed people jobs. But what we found out was that, say, hey, we're going to put your check in direct deposit. Guess what? They don't have a checking account. Guess what? They think the bank is the payday lender in the corner next to right. Why did they go and get that loan at that payday lender? Well, I wouldn't sign that, you wouldn't sign that, but you know what? If you know you need the money and you know you're illiterate, you probably didn't read it, you just signed your name because you're embarrassed and get your money go. So we've tried to combine that. So in other words, investments with access for folks, and then also financial literacy around it. So we do quite a bit of that. Regarding Dan Gilbert himself, I mean, you know, what he's doing is great. A lot of those loans, we've looked at him, but a lot of those he hasn't borrowed funds for. I think I've done my part, though, as a shareholder, because we sold him the First National building. Which is kind of a funny story, because I was in Pittsburgh. They were packing my belongings in my house. Literally, I mean, this guy's walking out, and my phone rings from this guy that I know from Detroit, I don't know the name was. And he's screaming at me because I've known him since 1991, and I won't sell him the First National building the price he wants to pay. And I said, you know, if it were a tie, I would give you that because you're a customer of the bank. But I have this other offer for $600,000 more. So I'm a fiduciary of the shareholder, right? So we sold it to these other guys who then immediately flipped it to Dan Gilbert and made it worth walking off their way. And I think they're still mad about that, but I mean, that's how it works, right? I have shareholders I have to take care of. We own that building. Also, if you think about the first deals I picked up when I was in Cleveland, when we were doing the due diligence, they kept throwing Detroit deals at me. Hey, Mr. Detroit, here's one for you. The first two were the office building adjacent to Symphony Hall, the Max Fisher Theater for the Detroit Symphony. And the second one was the book Cadillac Tower. You don't know anything about the book Cadillac Tower? I think it's 23 stories high. My guess is it probably has a layer of capital as many stories high. You got deeply subordinated, deep subordinated people. But, so I mean, we've been pretty active. It's no secret that we're not physically in Detroit. You know, and I'll just tell you, there's only 2 cities, St. Louis and Detroit, that we're not in the central business district. But we inherited this long-term lease that's still awful. Unless you want to buy me out of it or something, we'd be happy to consider moving. But you know, quite frankly, it'd be hard for me to move, because a lot of people that don't make a lot of money, talk about administrators, have chosen to work for us because of where we're located. I mean, for me to pay city income tax and parking, those things might not be the end of the world for me, but if you're making, you know, $35,000 to $50,000 a year, that's a big hit. And I think I might have, you know, insurrection on my hands. But with that said, it doesn't matter. I mean, we're way, National City, like long-term, terrible leases, it seems like. So we're kind of stuck, if you will. But I think, in addition to answering your question, another thing, we do give money to the Detroit Regional Chambers Foundation to spur economic development. That's where I was this morning. So a number of us actually help seed that fund to attract new business, if you will. So we're probably involved in a number of different ways, but I would say financial literacy, new market tax credits, low income, historic. David Whitney building would be an example, something we're getting involved with. I'll be taking over the tax credits from Bank of America on that. So I mean, so we're pretty involved. Do I wish we were in Detroit? Yes. Will it happen? Probably not until at least goes away. But it's become a big issue. You know, but I try to get to Detroit with some frequency. I am on the board of Downtown Detroit Partnership. I'm also on the board of Detroit Public School Foundation. So I'm there quite a bit. Try to be. Yes, sir.
Yeah, this.
So you're a plant. So.
Just because I don't really have that much familiarity with the process, so if you could just enlighten me a little bit about it. When you did the merger, the buyout of National City, how did the valuation of National City actually go about? And you know, I'm sure you use an investment bank. How did that process work in choosing which bank to use and to go forward with that?
Well, both the seller and the buyer, as you know, have investment banks that represent them. In our case, the old-fashioned approach is probably a bottoms-up, which is what you do some sampling statistically relevant on the portfolios, build a reserve, and then try to put a slush factor in there and then make your bid. You know, we bid, I think I'm right, I think it was $2.35 a share, and I think U.S. Bank was $2.25, something like that. Keep in mind, by year prior, they were $31 a share. And you just start thinking about that. But you know, we just rode that thing down. But so that's how the bidding process still to this day works. I would tell you today to do a bank merger would be pretty difficult from the regulatory standpoint. You know, we have to get permission even to set our dividends. But so I'd be surprised unless it's under stress. I get asked a question a lot about why we don't buy little banks, FDIC banks that come up for bid. We see them all, but we never buy one. The reason why is because our view is that the reps and warranties that go back to the federal government are so onerous, we'll never know when we're done with the acquisition. So we look at them just of interest, but you won't find us buying Oxford Bank here that had some issues. I mean, it seems like it's too onerous for us. It's better for a smaller bank to do that. Seems like to us anyway. Plus, I'll be candid with you, doing a National City merger was probably as much work as we bought Mercantile Bank in Baltimore, which was probably 20% of the size. It's about the same amount of work done. So, you know, but that's it was that. But I'm not sure I'd use National City as the standard bearer for, you know, normal acquisitions. Right? Riggs Bank in Washington, you might remember, and maybe you've never heard of it. It's the Bank of Presidents. Every president of this country had a bank account at Riggs, going back all the way to the Louisiana Purchase. Think about that for a while. In fact, Riggs Bank was the Federal Reserve before the Federal Reserve, pretty much. That bank failed, had problems because of some Argentina dictators. And, only time, by the way, I've ever been interviewed by the CIA. not the FBI. I was like, whoa, okay. But, and so unfortunately, the government called us and said, hey, how would you like to buy these guys? And so we did. But, that was, Mercantile Bank in Baltimore was 07, and that was more of a normal quote-unquote acquisition. Anything else? Yes, sir.
Can I get one more in? This is an easy one.
Pretty easy.
Many of our students are probably not aware that, and this was before their time, that we had significant limitations on interstate banking. So we had our NBDs, Detroit Bank and Trust. There was also Glass-Steagall Act and limitations on separation of investment and commercial banking. Of course, then we entered this period of deregulation. Can you comment on that? Did that in part lead to the crisis? Was it inevitable that we had deregulation? Was it handled in an inappropriate fashion?
Well, you know, it's interesting. Let me take you back. 1991, I was in Cincinnati through 96. I was an officer of the bank down there was called Central Trust before we changed, you know, we owned it. But I was an officer of Central Trust Cincinnati, Central Trust Northern Kentucky, Central Trust Kentucky, and the Mortgage Corp. We had our own mortgage corp. So I would offer to you that from a cost standpoint, for the shareholders, you can think about all these reports that go up. The collapse into these charters really was made a lot of economic sense for the shareholders. I'd also offer to you there was mischief in some of that, and I think it's gone. They used, before we bought them, the mortgage company, like say the legal lending limit was $10 million with the bank. Well, guess what? You know, we'd lend you 9.9 over here at the bank and 9.9 at the mortgage company. What? So there was a lot of that stuff going on too. So some of these mortgage companies that were part of the banks, I think it's better for the public that that kind of stuff is gone from that standpoint. We don't underwrite equity, we never have, never will, even though our chairman of the board, Bill Demchak, I'm sure could, but he just doesn't think we kind of think we're a Main Street bank. What I'm talking about is, you know, somebody goes and buys somebody and underwrite the equity. We get some of the bond economics, but only as a throw-in because we're, you know, a big lender, if you will. But we don't underwrite equity, so from the Glass-Steagall, I'm not, you know, it's not relevant to us. So I think some of the deregulation's been good and some of it probably has been bad. I don't know about you, I'm pretty good at reading upside down because I started my career as single-family mortgage lending. I still can't quite figure out why some costs in getting your mortgage are in truth in lending and some are out. What I mean by that is when you calculate all that stuff that you have to sign, you get your annual percentage rate, some of the costs are in there and some aren't. And you're like, why? Well, how come the survey's not in there? Well, it's not part of it. And so the consumer is just confused. Is it all my costs? No. It's just these that we think really are important. So I think some of it's not as transparent as it needs to be. And now we got a new agency to watch that, right? And so the Consumer and Financial Bureau is going to be interesting to see, you know, how that works. But I sometimes worry that everybody is in there trying to get in each other's stuff, if you will, from a regulatory standpoint. But we're not going to go back to some of the days of, you know, wild and crazy. I just don't see that. I was in Washington about a month ago on the Hill, as they say, for 2 days, me and 29 of my closest friends at PNC. And it's funny when you go to see your Congress people and your senators. So I saw Debbie Stabenow, Gary Peters, and a few others that were either on the Senate Finance Committee or on the House Banking Committee. And what we were doing there was trying to get the point across that you need to look at not the size of banks, but their collection of businesses to adequately measure risk. And everybody got it, right? But are they going to do anything about it? I don't know. I think at the end it's still nope, 50, 100, 150, 200, you know, they just go that way. I think they're all smart enough to understand the concept, and that's what we've been talking about. Is we're not involved in these black pools. I have a pool in my backyard, but that's the only pool I know. We're not involved in that. We don't, you know, we're not in Taiwan, you know, in Hong Kong. We're not international. We have an office in London and we have a branch in Toronto, but we have somebody in Shanghai, but we're not doing some of the things. So it doesn't seem to make sense to everybody. You look at the risk buckets and you measure, but I don't think that's really in vogue right now.